Lot sizes. What are they and how can you begin to maximize this and use it to your advantage? That's what we're going to talk about in today's class. My name is Gloria Zoe and popularly known as the Pips Grabbing Chick. And today you will know how you can make money or break money in the Forex market by these two very simple words. Well, very, very make or break words. Lot size. What is lot size? It's simply the size you use to carry out a transaction, usually graded in bundles or units, alright? Or also referred to as the trade size. Like you can see, this right here is a crate. It is a crate of egg. You don't go buying them in units. Well, in Nigeria, you could buy them in units anyway, but it makes more sense to buy them in crates because when you do so, you're able to get it at the bundle price. So it's something also for the currencies, they often come in lots. The minimum of which is 1,000 lots, of seen as the micro. And we have the mini, that's 10,000 units, seen as the mini, and the standard, that's 100,000 units. So you don't go saying you want to buy €1 USD. You often buy them in lots. So you're trading the Euro USD. You're using the micro. What you're doing is buying 1,000 of it, alright? The 1,000 unit currency of the Euro USD. Or you're buying 10,000 unit currency or 100,000 unit currency, right? So there is no such thing as I want to buy €1. Okay, most as you would go and say I want to buy one egg, you mostly buy them in crates. So you would buy or sell it in micro or the standard. So how are we now going to really understand this? Like, how do we put all of this into perspective? Knowing what we know about pips, knowing what we know about, price index point, how can we marry these two things together? That will take us to the next aspect of this, which is seeing this lot in play. So we've learned first off about the micro, the mini, and the standard. The standard is one of the lot sizes that most people are excited about because it is 1.0 in volume. So 100,000 units, just simply the volume price of it is 1.0. Okay, so it means that for every time the market moves, you're making $10. For every pip move, you're making $10. That's what it translates to. So this 1.0, the money value or the dollar pip value is $10, alright? The next one would be 0.1. Of course, 1.0, 2.0, 3.0, as it progresses, you add it to 1.0, $10 per pip, 2.0, $20 per pip, 3.0, $30 per pip. So you already know, you keep taking it. And 100.0, that's $100 per pip. So as you continue to advance, you continue to use. So yes, these lot sizes are usable. There are people who uses 100 lot size, alright? That's 10 standard lots. There are people who use 50 standard lots, people who use 20 standard lots. So it all depends on your money and it all depends on your leverage. Remember how we talked about leverage a while ago? Did you watch that video? You didn't, go back and watch it. So remember how we said leverage is what the broker offers, alright? The broker gives you that leverage to say, okay, for every $1, we're going to back it up with $10, or we're going to back it up with 20 or 50 or 100 or even 1,000. So this is where your leverage comes to play. This is where the power of your leverage is felt or tested. Okay, so if you have a very big leverage, like 1 to 1,000 leverage, you can now begin to say, I have $100. I want to use one standard lot because $100, one standard lot, that's $10 per pip. So for every time that the market moves in your favor, you're making $10. So imagine now that you are able to drive the market or carry the market all the way to 20 pips or all the way to 30 pips. That's $10 times 30. That's $300 out of your $100 capital. So you just funded your trading account with $100, and here you are cashing out $300, and here you are cashing out $500, here you are cashing out $1,000. So that's the beauty of the leverage and the beauty of the lot sizes. Okay, so That's the standard. That's why a lot of people are excited about the standard lot. Yay, I want to use 1.1 thousand. I want to use 1 to 500. Because they can use all these big lot sizes, very small capital. Okay, so the next is the mini. The mini is the 0.1. That's $1 per pip. 0.2, $2 per pip. 0.3, $3 per pip. 0.4, you get a picture. So you continue to advance up to 0.9, that is $9 per pip, and then you get to the standard lot size. So remember, the standard lot is the standard, 2 standard, 3 standard, 4 standard, 10 standard, 50 standard, on and on and on. And the smallest of them all, the micro. The micro is a 0.00, that's a 10 cents per pip. Most traders are not really particular about this. Like when you show them this, they're like, I'm not making any money trading this lot size. So most of them don't like using it. But here's an advice. As a beginner, this lot size is good to start with, because with this lot size, you can begin to train your emotions. Because take note, here's a caveat. For every time you are upping the lot sizes, think of how much you're going to lose. Yeah, you're going to get that when we talk about risk and money management in a few minutes. Okay, so the lot size must always be thought in both directions. Don't only get excited that, I have the potential of making $3,000 because I'm going to use 5 standard lot size and all that. Think of the losses also. So the micro is often not, people aren't excited about the micro. So you tell somebody, I took a trade and I made 100 pips, and they'll be like, when it was your lot size, and you're like, it was a micro, just your 10 cents. They'll be like, okay, that's like $10. That's okay. You know, so most of them are very excited about this one. And then this is seldom used. I think those who trade binary, the volatility indexes, the V75 and all that, this is all offered, the nano. And even at the offering, nobody offers 0.001. Even they start at 0.005 because this one is 1 cent per pip. Like seriously, who want to trade this? Not many people. So most brokers don't offer the nano. Binary, derive.com, those brokers that trade the V75, V10, V25, blah, blah, blah. They offer 0.005. That's 5 cents per pip. So I don't think any broker offers 1 cent per pip. So these are the lot sizes. 0.01, that's 10 cents per pip. All right. 0.1, $1 per pip. 1.0, $10 per pip. Now the pip is your decision. The pip is when you begin to exert your right as a trader to say, this is my decision. This is the lot size I want to use. So this is the blah, blah, blah I want to use. What I meant with lot size, not the pip. Lot size is your decision. It's when you begin to exert your rights as a trader. So I'm not going to tell you, hey, make sure you only use 0.01. No, that's for you to make. But remember, for every lot size decision you make, think of the flip side, okay? The good side is if you use 1.0, you stand a chance of making $10 for every pip move. So say you make like 100 plus pip on a standard lot size. Yeah, you already know that's $100 times 10. That's $1,000. So that's cool money right there. So if you're going to use this lot sizes, think about what I'm about to talk about now, risk and money management. Very, very vital. Risk and money management is just how you as a trader can now begin to manage your money. How you can manage your money. The whole essence of this market is for you to make money. If you want to make money, you have to know how to manage it. You don't want to abuse anything. That's why I said leverages can be abused and it can be maxed out. So you can maximize leverage, you can abuse it, you can use it right. So if you're going to be maximizing leverages, it means that you're using the whole $1,000 and you're just maxing it out like that. You know, with $100, you're throwing in 1.0. I see a lot of videos of people over leveraging their account. That's what we call over leveraging. I see videos of that. You know, they have $100 and you see them using 4.0 and they have like 3 positions. That is the reason they were able to use that kind of lot size for that account, because they have very big leverages and the broker allows them. So any fluctuation in price, the money is gone, and any fluctuation to their advantage, they are flipping account. So traders get excited by styles like this. They get excited. So that's maximal abuse of the leverages. So don't go over leveraging. Okay. Always make sure that you manage your money to make your money. So how do you begin to use this lot size understanding to manage your money and manage your risk? That's what we'll talk about, placing a take profit and a stop loss. So for every time you want to trade, you want to know how much you want to make. When people say Forex is risky, they are saying it out of ignorance. Forex is about one of those ventures that you come in already knowing your risk. Most of the brokers will give you that disclaimer because they are authorized by law to give you the disclaimer that 75% or 80% of people who have traded CFD, blah, 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 have lost their money. That's a standard disclaimer that they are mandated by law to give. But here's the thing, for every time you go into a transaction, you know how much you want to lose. That's where your risk comes in. So before you want to make $50, tell yourself that I want to make $50, but I'm going to risk $20. So I want to risk $20 for $50. Some will even say I want to risk $10 for $50. You always know how much you're risking, and your risk must be smaller compared to your reward. So the risk is the stop loss. That's the risk. So when you say you want to risk $10, it means that you just want to place a stop loss of 10 pips. You want to place a stop loss of 15 pips. So the standard stop losses to place is around 10 to 30 pips. So some traders do 10 pips, some do 15, 20, 25, 30. So you have that range from 10 pips to 30 pips, okay? And then of course your reward will begin to approach from 30 pips to 50 to 100 to 200 and on like that. So make sure that your risk is smaller compared to your reward. So if you have that kind of risk in mind, you now begin to decide lot size to use. So if I want to set a stop loss of 10 pips, how much lot size will I use so that I can only lose $10? Then you want to only use a 0.1 lot size. If I want to take a risk of $1 to make $5, what lot size will I use for a 10 pip stop loss? You want to use 0.01. If I want to risk $100 for $500, how much lot size will I use? You want to use 1.0. So it is knowing your risk that will now guide you in using the appropriate stop lot size, okay? Because as you're making the money, say I'm using 1.0, think about the flip side, which is the loss. Okay, so knowing that will now guide you that, okay, this is my stop loss, this is how much I'm going to lose, and this is the lot size I'm going to use. That way, you're able to manage your money, you're able to maximize profit, because the whole essence of you trading this market is to make money. And if you want to make money, you have to make sure that you put to practice what I've just taught you, managing your risk and managing your reward, and that is where choosing the right lot size comes in. So how will you pick the right lot size? Pick the right lot size based on how much you're willing to risk. Always know your risk. Always know your risk. Don't leave your market open. Say, I don't want to use any stop loss. I don't want them to take me out and then only for them to go in my direction. If the trade hits your stop loss, that's fine. It simply gives you another opportunity to retake it at a better place, alright? So always place your stop loss. Always know your risk and use that to guide you in choosing the lot size, because being able to do so will help you properly manage your money and maximize your profit. I'm very agree once again. This is where we'll stop today's class, and in the next class, we're going to talk about orders and how you can place them. Thank you for watching. See you next time.